Hi, I'm Doug Johnson. I'm the tax manager with Ballard & Company, a CPA firm located here in downtown Mountain Home, Arkansas. I'm going to talk to you today a little bit about what's called a 1031 exchange, which is basically exchange of like-kind property for other like-kind property without incurring a tax burden or at least a lesser tax burden. Basically, it is a swap of like-kind property for like-kind property. Real estate for real estate, personalty for personalty. In fact, if you trade your car, you participated in a 1031 exchange. This is just done on a different scale. There are restrictions on the types of property that you can use. It has to be investment property or property used in the productive use in a trade or business. That means you can swap an apartment building for a farm, or you can swap a farm for a farm, or you can swap an apartment building for a condo, or just as long as they say there's leeway in designating what is like kind, but it is important that they are. You can't swap an apartment building for a car. Not that you'd want to, but your personal residence would not qualify. It is a personal asset, and therefore it is not an investment property, and it's not for use in a trade or business. There are several different ways to do this. You can do a straight swap, one-on-one, when you've got something and another guy has something, and then you can just swap straight on it. Another way to do it is either a deferred exchange or what they call a reverse exchange. This will involve having a qualified intermediary or an escrow agent or something along those lines. The rules are very strict. You have to follow them to the letter in order to get it. Once you've transferred your property in to the intermediary, you have 45 days to identify other property. It must be specific in writing. Then you have another 180 days in which to finally consummate the transaction. There is one caveat in there. It's the quicker of 180 days or when your tax return is due for that year. So if you make a swap in December, you'll need to get an extension on your tax return, because otherwise you'll have to complete it by April 15th. You can sell or have the intermediary sell one piece of property and get back 3 different properties or whatever, as long as the fair market values are relatively equal. If you receive any cash out of the deal, that can be taxable. Also, if you give up more debt than you take back on, that's considered as cash received, and that will be taxable. But it won't be the full tax. You can never pay more on the tax than your actual realized gain on it. This is a great way to move up and not incur a crushing debt burden or tax burden. The big deal is identifying the property, making sure you fit the guidelines. You really need to consult with a tax advisor on this. It's becoming very, very popular. You will have a carryover basis, so to speak. Whatever you had in your old property is what you're going to have in the new property. So you won't get a higher depreciation deductions or anything like that. But then again, you don't have the tax gain. Also, sometimes a lower basis you may want. Like if you're getting a certified rehabilitation type building, the lower gain will allow you a bigger credit because of the rules in there. This is just a big overview of it, and it is a good way, like I say, to acquire other properties without incurring tax costs. The state of Arkansas also recognizes the 1031s in all its various shapes and sizes, so that you will also avoid any state gain here. If you have any questions about this, give me a call, Doug Johnson at Ballard & Company. My number is 870-425-6256. Our website is www.ballardcpa.com.